So despite major trade disruptions and policy uncertainty, last year ended on an upbeat note. The private sector adapted to a changing business environment, helped by lower than announced US tariffs, fiscal support in some countries, favorable financial conditions, and a tech boom. Despite downside risks, this momentum was expected to carry into 2026, and we were looking to lift up our global growth forecast. Now, war in the Middle East has halted this momentum. The closing of the Strait of Hormuz and serious damage to critical energy facilities in the Middle East raised the prospect of a major energy crisis should a durable solution not be found soon. Our report presents three scenarios. Our reference forecast assumes a short-lived conflict and a moderate 19% rise in energy prices in 2026. Still, some damage will not be avoided. Global growth falls to 3.1% this year, a downgrade from January forecast, and headline inflation rises to 4.4%. Our adverse scenario assumes further disruption, leading to higher energy prices and inflation expectations and tighter financial conditions throughout the year. Growth falls to 2.5% this year, and inflation rises to 5.4%. Our severe scenario assumes that energy supply disruptions extend into next year, with greater macro instability. Global growth falls to 2% this year and next, while inflation exceeds 6%. Downside risks are clearly very elevated. Now, the impact of the war will be uneven. Low-income energy importers are highly exposed, especially those with pre-existing vulnerabilities and limited buffers. But the damage is most severe for countries in the Gulf. Today's shock echoes the 2022 commodity price surge. Then, central banks delivered a successful disinflation without a recession. Can we expect the same outcome now? There are reasons to doubt it. In 2022, inflation pressures were already elevated by post-pandemic support policies. Today, underlying demand pressures have eased, though inflation remains above target in some countries, notably the United States. If the shock remains modest, inflation may be more contained, consistent with our reference scenario. So what should policymakers do? Let's start with central banks. This is a negative supply shock, and no central bank can influence global energy prices on its own. Markets are already pricing in higher policy rates. However, provided inflation expectations remain well anchored, central banks can afford to wait and watch for now. But they must be attentive to risks and communicate clearly their readiness to act decisively to maintain price stability. Finally, if financial conditions tighten sharply, as in our severe scenario, and global activity deteriorates markedly, monetary and fiscal policy should be ready to pivot to support the economy and safeguard the financial system alongside appropriate financial and liquidity policies. Now, the war demands immediate attention, yet it should not derail from the pursuit of durable growth.